This week, we saw a continued rise in bond defaults and a decided drop-off in lending, especially in Europe. To take us through the two developments and whether they may be connected, welcome back now Bloomberg International and Economics correspondent Michael McKee.
Can you have too much of a bad thing? To control inflation, central banks raise interest rates. Credit becomes more expensive, fewer people and companies borrow, and economic activity slows. Monetary policy is working by that book in Europe. This week, the European Central Bank reported demand for loans among companies in the Eurozone plunged by the most on record in the second quarter. Demand for mortgages and other consumer borrowing also fell. Could that be a sign the policy has gone too far? Well, banks play a dominant role in financing the European economy, and the Eurozone has seen 2 consecutive quarters of economic contraction. It's a different story in the U.S., where growth has remained stronger than expected. There is bank lending, of course, and it's flattened out in recent months. But the capital markets play a much bigger role here, and there are incipient signs of trouble in those markets. Defaults are beginning to rise, no surprise, particularly for commercial real estate. But a New York Fed index shows stress in the bond market is up, even for investment-grade bonds. For the Fed, like the ECB, the trick from here is to keep the pressure on inflation without turning lending stress into economic distress.